Welcome to this video from Kepsfield Academy. In this video, we will dive into the topic of DCF valuation, a widely used method for determining the intrinsic value of an asset or company based on its expected future cash flows. Let's revisit the most commonly used valuation methodologies: intrinsic valuation through a bottom-up approach, relative valuation adopting a top-down perspective, valuation grounded in accounting or book values, and lastly, valuation predicated on the costs to construct or replicate a similar company or asset. Today we'll focus on the first approach, the intrinsic valuation via a bottom-up method. The discounted cash flow, DCF, valuation is one of the most commonly applied techniques within this category. A significant advantage of DCF valuation is its ability to provide a tailored assessment of an asset or company's intrinsic value, as opposed to market-based valuations, which rely on industry peer comparisons. Additionally, DCF valuation is based on free cash flows, making it less susceptible to the subjectivity of accounting figures and reporting standards. It offers a rigorous and flexible valuation framework for valuing businesses based on cash flows and long-term performance. Conversely, the accuracy of DCF valuation depends heavily on assumptions about future performance and discount rates, which can be difficult to predict. A DCF valuation can be complex, requiring a deep understanding of financial modeling and valuation techniques, which can make it difficult for non-experts to use and understand. In particular, the value after the explicit forecast period is difficult to estimate and requires technical inputs and assumptions that can have a large impact on the overall valuation. Finally, DCF valuations are based on a company's unique characteristics and assumptions, which can make it difficult to compare the valuation results across different companies or industries. A DCF determines the enterprise value of a company by calculating the free cash flows to the firm and using the weighted average cost of capital to translate these into a value today. Let's explore the essential elements of the discounted cash flow (DCF) methodology, determining the enterprise value of a company. A DCF valuation is a two-stage model that includes an explicit forecast period and a terminal value period. The explicit forecast period is the time frame during which cash flows are projected. It typically spans 5 to 10 years, depending on the company's specific circumstances. Most important, it considers the time needed to reach a stable growth and returns for the target company. The terminal value, sometimes referred to as continuing value, represents the company's worth beyond the explicit forecast period, assuming it continues to generate cash flows. This value often constitutes a significant portion of the company's overall worth and requires careful estimation. Free cash flows to the firm, or unlevered free cash flows, represent the funds available to equity and debt financiers after the company has received payments from clients, covered expenses, and invested in profitable projects. These cash flows reflect the actual cash generated by the company, free from accounting practices or reporting standards. The weighted average cost of capital, or WACC, combines the required returns for equity and debt investors, taking into account their respective proportions and risk profiles. The WACC is essential for discounting the projected future cash flows to their present value, capturing both the time value of money and risk. To perform a comprehensive discounted cash flow (DCF) valuation, it's essential to follow several key steps. Let's explore these steps to ensure a successful DCF valuation. Step 1. Understand the company and its industry dynamics. Start by examining industry reports, news articles, and expert opinions to gain a comprehensive understanding of the market environment. For example, if you're valuing a tech startup, research the latest technological advancements and competitors in the field to evaluate the company's growth prospects. Step 2. Analyze the firm's business strategy. Review the company's annual reports, management presentations, and strategic plans to understand how it plans to grow and maintain its market position. Look for any competitive advantages or unique offerings that could drive long-term success. Step 3. Examine the drivers of historical performance. By reviewing the company's past financials, you can identify patterns and trends that may impact future performance. For instance, track changes in revenue, operating margins, and capital expenditures to understand how management has allocated resources and optimized operations in the past. Step 4. Calculate the cost of capital. Analyze the company's capital structure and determine the appropriate discount rate. This may involve researching industry-specific risks, estimating the risk-free rate, and calculating the expected return on equity and debt. Remember to consider the impact of taxes on the cost of debt. Step 5. Build a two-stage DCF model. Use the insights gained from industry analysis and historical performance to project future cash flows. For example, estimate future revenue growth based on market size, penetration rates, and competitive dynamics. Also, consider how operating margins and capital expenditures might evolve as the company grows. Step 6. Discount the projected cash flows. Apply the calculated WACC to discount future cash flows. To illustrate the impact of different assumptions, perform sensitivity analyses by varying key inputs, such as revenue growth rates, operating margins, and discount rates. Step 7. Cross-check the results with alternative valuation models. Enhance your analysis by comparing the DCF valuation with other methods, such as the multiples approach using industry comparables. This can help validate the DCF results and provide additional insights into the company's relative performance. Step 8. Interpret and present the results. Summarize the findings in a clear and concise manner, highlighting key insights and potential risks. Use graphs and charts to visualize the data and make the results more engaging for your audience. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.